Welcome back. You're with Money, and we are in conversation with Mr. Nimesh Shah, MD and CEO of ICICI Prudential Asset Management Company. Nimesh, so talking about equity, and I know you're advocating a product which should have a mix of both equity and debt. But how does the product work? And if you could give us some sense of how the cutoffs are decided. I mean, when should you be more inclined towards equity? When should you be more inclined towards debt? Because a lot is changing. Interest rate, the cycle itself is changing. The market is right now going back towards the higher levels. So how should this be done?
See, traditionally we have learned if you want to make money in the markets, you have to buy when the markets are low and sell when the markets are high. But what we have seen, the retail customer, normally he gets into the market when past returns are good. So by the time the past returns are good, markets are already high. Right. So he comes in high and he panics when the markets are low. So we have created around 2 years back, around 5 years back, we had created a product whereby we would say we would do exactly reverse of what a retail investor does. So and we will not allow human emotions to come into play in this. So we said we will the best indicator of whether the market is high or low will be in a price to book ratio. So we have mapped over the last 20 years the various price to book ratios and how it works. After that we have come with an algorithm that at every price to book level of the market, we will decide what should be the equity allocation and what should be the debt allocation in this particular fund. Normally mutual funds invest whatever you give me, I invest it in equity, right? Because if it's an equity fund, it has to be always invested. In this fund, we don't have that. So when the markets were at 28,000 and 29,000, this fund would typically have 30 to 40% into equity and 60 to 70% would be in debt.
Okay.
But when the markets have become cheap, when the markets had gone down to 23,000, this fund had almost more than 75% to 80% into equities.
Okay, so you're actually buying more when the market is down.
So it's every day if the market, today the market has gone up, this fund would have sold. When the market goes down, this fund goes and buys. So it is done by the automatic by the price to book ratio of the markets.
Okay, not price to earnings. Price to book is the parameter.
We believe that price to book is a better long-term parameter to follow for asset allocation. So for asset allocation decisions, we use this price to book model and it has worked very well for the product. Over the last 7 years, if you see, it has done very well. In fact, by taking much less, what you are doing by this process, that when markets become expensive, you go away from the markets, you get into debt more, and when the markets are cheap, you get into equity. So your risk in the product is always very less. So despite taking much less risk in the product, we have been able to beat benchmarks, the Nifty benchmark, not this fund benchmark, the Nifty also quite a. So by taking very low risk, you are able to get more returns than what the equity markets, the Sensex gives, and it's a very good idea to do. So this fund has done very well. The kind of investors, the common man of this country has come into this fund. It's more than a 10,000 crore fund, which we have grown in the last 2 years, and it has done very well. Last 1 year, when the markets have been almost negative 7% plus, 7.8 or something like that, this fund has given 1% positive return.
Okay,
so that's
because of the mix between.
So you protect your downside. We believe as a fund house, it is very important to protect downside rather than trying to capture every upside. Because statistically also in the Indian markets, if you protect downside better than trying to capture every upside, then you do better. Because there are more number of days the market falls than the number of days the market goes up. So statistically also it is good tool to protect downside rather than capturing upside.
I guess problem is most people think of downside only when they see negative values in their portfolio, not when they're actually allocating their investment strategy. But for people who are also looking out for pure equity funds and pure equity investments, is this the year you should allocate more of your capital to large caps, or should you be looking at sectoral thematic funds? Should you be looking at mid-cap funds, which obviously are far more volatile, but hopefully will generate better returns?
I would rather look at risk-adjusted return than absolute returns. Yes, there is a good opportunity to capture mid-caps which are doing well, etc., etc. But see what has happened in the last 5-6 months as the FIIs were selling, the markets had corrected, so the large caps have got corrected. But the mid-caps, the corrections has never happened till now, right? So I feel that from a risk-adjusted point of view, I will strongly urge your investors to invest in large-cap products. Because risk-adjusted for large caps is better today than mid-caps, and upswing coming in the economy, the large companies of India will also benefit by it. So risk-adjusted point of view, products like ICICI Prudential Focus Blue Chip product, which essentially only invest in large cap stocks, is good for the final investor.
Do you see any sort of return of thematic funds, sector-specific funds, some interesting theme-based funds? Of course, typically that happens when the market is really surging, and there's a lot of.
If you have got knowledge about those those sectors, I would say be very, very cautious about thematic funds. If you are knowledgeable, we have got sector funds like banking fund or the key in this is that you should know what is the bottom of that sector. If you are aware about banking and you know that 2016 might not be very good for banking and the banking stocks really crash, then that is the time to invest in that fund.
Right.
Because when the upside comes in, you will capture that. But for that thematic fund, the person should be knowledgeable, he should understand the market well, and he should time the thing well. Otherwise, you should not be in thematic funds. It is better to be in large cap diversified funds.
Well, another quick break right now, but on the other side, we're going to spend some time trying to understand debt funds that are on offer in the market and whether you should be thinking about them alongside your traditional investments like fixed deposits. That's coming up after the break.